Hi guys, welcome back to the channel. I'm Arab the blog, and in this video we'll be talking about how to identify structural key levels on your chart. You probably have been trading the forex or the crypto market and you find it difficult always to know where to trade from. You find it difficult to draw where to take your entries from, especially when the market is an uptrend, downtrend, or even in a ranging market. So this video is going to help you identify key levels, important key levels that you may not have known before, because sometimes you may be drawing your key levels the wrong way. So in this video, we learn how to draw your key level the right way, which key level is important for you to trade from, and which key levels should you know whenever you see them on the chart. So in this video, then we'll talk about these things using the ranging market, using the market when the market is an uptrend or even a downtrend, and also we'll be talking about reversals, how to identify reversals in the chart and how to trade them. So make sure you stick to the end of this video because you are going to be getting a lot of value for your time. So let's dive right into my chart to identify these things and find potential entries for your potential trades in the market. Alright guys, welcome back to my screen. So let's see the structures. Talking about the structures you should be looking at whenever you are looking at the market. So looking at this structure that I have on my screen. So let's start from trending structure. The market is trending. Let's look at a downtrend and the uptrend. So this is a structure you likely would have in a downtrend market, and you will see that whenever the market comes down, it pushes up, then comes back again and pushes up. So now, having a structure like this, one of the mistakes that a lot of traders do whenever they're analyzing the market is looking at this structure in a wrong way. So now, when the market comes down, reverses, comes down and reverses, if you want to look at the structure for this market, let me get rid of this and find a way to. So let's look at something like this. The market comes down, makes a low, a lower low, a lower high, then a lower low, then the market makes a lower high. Majority of the traders would take their entries from this lower high, which a majority of traders would want to take their entry from somewhere like this, from this area, which is not totally a bad thing to do, but in most cases the markets tend not to respect this particular point. So what I'm saying in a sense is that you as a trader have to be able to be flexible with your structures, with the places where you are taking your trades, mostly in the market, because sometimes the market does not respect this particular area, because majorly the institutional traders want to trade from an area that is more reasonable and is more solid in the market. So in this market structure, the market is still in downtrend until, let's say, we have a situation where the market comes and probably breaks above this particular area, and then that is when we say the structure has been broken. So far the structure is not broken, the market in this scenario is still in a downtrend. So what I'm saying is that this particular area of value, this particular lower high that created this lower low, is pretty much the most important and the strongest structure in this particular market. The probability of the market pushing this market to a new lower low is higher if the market comes back to this zone and gives us a zone that we can identify as a supply zone, right? So if you are looking at this structure, one thing I will do as a trader is that I will prefer if I look at this structure first and I see if the market reacts to this structure, and if it does not, I wait for the market to probably do something like this, to come up to this structure and find my entries from this structure, because this structure that created this lower low has the capacity, psychologically has the capacity to create a stronger lower low than this particular structure that is the lower high in this particular scenario. So now let's say the market comes back to this particular area, then we have something like this, right? We have something like this, and this is what you guys would call a double top, because in this kind of scenario, we have a situation whereby this could be a double top, and this particular area, this is double top that can give us a much lower low, and this particular area would be a neckline rather. So now, in this kind of scenario, if I want to draw my structure in this kind of a chart, I would regard this area as the area of my structure. I will regard this area as my structural high, such that anytime market approaches that place, I'll be looking for an opportunity to short, because this is where the institutions would want to be taking short, because it is a previous lower high that created a lower low. So the essence of is that whenever I'm looking at structure, I want to be looking at previous lower highs that created the lower low that we have, because that is a position in the chart that is likely going to create a lower low that is a very strong, and this is going to give me a high probability trade whenever I am trading. So looking at an uptrend, you see you have something like this, the market going up, then creating a higher low, then the market giving us a higher high, right? And then something like this. So now, if you look at this particular structure, a lot of traders would want to enter their trade right from this lower high. Why? Because it is the existing lower high that we have in the market, which is not totally correct. Yes, it could be correct, because market might reverse from this and start pushing up. But if you're looking for the highest probability trades, you want to be looking at the structure, the lower high that created the higher high, the previous higher high, the recent higher high. And that is why I'll be looking at something like the markets pushing downwards to this particular area to get a higher probability trade from this place. This happens a lot in the market. This happens a lot on the chart, and institutional traders trade a lot this way. So what I want to do is look at potential examples for this kind of scenario and see what happens on the chart. This is a chart of Euro cards on the daily time frame, and you will see in this structure, this is a downtrend structure where the market create a low high, a lower low. Then here we have a lower high. We have something like that looks like a low here. But as a trader, you don't want to be trading from this structure. Why? Because the probability of this structure giving you a higher probability trade is low. So looking at the scenario I created, you would want to be trading from this high that created the previous low. You see that this high created this impulsive move from this particular point to this point. Then we have the market reverse, not to that place, then to somewhere around here. Then you wait for the market to come back to this place. And what happened when the market came back to this place? It created a very sharp movement. Downwards, which is going to be a very much high probability trade in this kind of scenario. So this happens a lot in the market, and you can just find an example of that in an uptrend market. By looking at this chart of Euro USD on a 1 hour time frame, right, you would see this structure is an uptrend. You see the markets are breaking out of this consolidation from this place, making a higher high, higher low. Then you will see that at this point, market was making a series of highs and lows that are tiny, but the market came back to this previous structure. Market came back to this previous structure that gave birth to this massive movement, right? This structure right from here gave back to a movement of this massive movement from this place to this particular point in the market. So it gave back to a movement from this point to this particular point in the market. Then the market came downward. You will see that during this movement, there are a series of movements, there are a series of lows that are creating that a lot of traders would be taking long trade from this point. A lot of traders will be taking a long trade from this point. A lot more traders would want to be taking a long trade from this point as well, and you will notice that most of them would have their stop loss get hit. So the structure created at this point, which is more like a structure that is a very strong demand institutional movement, is where you have to wait for the market to come back to this structure and give us a high probability trade. And you will see that in this scenario, if you had taken a long, if you had found an entry somewhere around this zone, put your stop loss here, and even target the previous high, like the previous high created, you will have taken a 1:3 trade. Then if you target more high, you probably will be looking for a very big movement in the market, even though it is unreasonable for you to say you want to set this place as a target. But if you look beyond the previous high a little bit, you will have been able to capture something like 1:5 trades, and maybe you move the stop loss a little bit down. So this is how to look at structure, and this is the best way, in my own opinion, to trade market structure. So let's look at reversal structures and see what the market has to say about that. Alright, looking at this reversal structure, this is pretty simple and straightforward. This is a lower, this is a downtrend. The market here is in a downtrend, moving down, and when the market got here, it got stalled, create a lower high. Then the market at this point would be expected to create a lower low, but unfortunately the market got stalled at this point, creating a double bottom. Same thing happened here. The market is an uptrend, create a lower low, then come back here and got stalled again. It's unable, at this point, it's unable to create a higher high, and same as this structure, unable to create a lower high. Then the market come back, it created a neckline here. You know, we are trading double top and double bottom. You see the market created a neckline here, and somewhere around here too is a neckline. Now this is a structure. For you to trade this kind of structure, all you have to do is wait for the market. To reverse back to this area of value, to this structure, and probably take a trade from this place, right? So this is my scenario for this trade, taking this kind of trade, looking at this kind of structure. The major scenario, the major reason why I want to take my trade this way is because if you look at this structure, the structure was previously in a trend. This is like a structure that is telling you that the trend is about to reverse, the market is about to trade, to change direction. And in this kind of scenario, this particular area of value is the structure that connects this movement upward to the reversal of the market. So I want to be looking at a scenario where the market is going to reverse back to this neckline or this area of structure, and then I take my short trade from this place. Looking at this structure as well, in this double bottom, you see that the market moves up, come back here and gets stopped, then starts moving up. So I want to look at a scenario where the market will move from this structure, will move from this area back into this structure, and I look for a way to long the market and trade it up there. So that is pretty much how I'm going to do this, and this is a lot of examples for this in the market. So let's dive into the market and see if you can get one or two examples for double bottom and double top notch. This is a pretty good example of this kind of structure. You'll see the market is in an uptrend, push up, right? Came back to this area, tried to push up again and got stalled. Then the market started coming down, even though it did with a consolidation. So now in this kind of scenario, the market came down to this place, but the market did not move immediately. The market did not move immediately. The market did a lot of consolidation around this particular zone. So that is why you have to be very flexible as a trader. You have to be able to look beyond what you are seeing on the chart and see what is going to happen. So the market pretended as if it's still going to move up, created a consolidation around this place, and then broke out of this consolidation to begin the downward movement that would have given you a lot of ROI if you have taken that trade. So in this kind of scenario, you look beyond the double top and double bottom and look at the structure the market is giving for you to take a trade. There's actually a lot of I have a lot of videos on double top and double bottom. I'm going to make sure I link all those videos in the description below, so you can watch my videos on how I trade double top and double bottom and how I make money from the market using the double top and double bottom strategy. So now let's go back to our structure and see the ranging structure. The ranging structure is pretty simple and straightforward. If you are trading the market in a range, I only want to be doing two things. I want to be taking the short from the high of the range and long from the low of the range. So I don't want to get involved with anything that is happening at the middle of the range. I don't want to be catching this short and this long. I want to be taking long at the high of the range and at the low of the range, because that is what makes sense to me. So let's look at using this as an example. This is a very good example of a ranging market, right? This is a very good example of a ranging market. You will see that in this scenario, all you have to do is take shots at the high of the range and target the low of the range. Anything aside that does not make sense, because you don't want to be taking shots from this place. You don't want to be taking any shots from this place, targeting here. It's going to be like a messed up trade, because eventually the market might come here and start going against you and your stop loss get hit. So if you are taking a ranging market, you want to be looking at the high of the range. You want to be sure the market has gotten to the high of the range for you to take your short, and the market has gotten also to the lows of the range for you to take your long. So this is pretty much how I look at the market structure, how I look at structure, and how I identify structures that I can trade from in the chart. If you got value from this video, ensure you subscribe to the channel, hit the like button, and I'll see you in the next one.